Hello, everyone. My name is William Mucker. I am a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, Financial Secrets of America's Wealthiest Families with Vince Munno of UFC Advisors. As a quick note, please be aware that Vince will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information if you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction. Please do not hesitate to contact me. I'll be more than happy to help. And without further ado, I'm going to pass the controls over to you, Vince.
Okay, Will, thank you. And thank you, everybody, for attending today's meeting. My name is Vincent Munno. I'm the CEO, founder of Universal Financial Consultants. And for the last 30 years, I've been working with other financial advisors, helping them with solutions for some of their wealthiest clients. We work with some clients that are, when I say wealthy, anywhere from, $1 million maybe on the low end to hundreds of millions on the top end. Even have some clients that are billionaires. So these strategies work for all different sorts of clients. I have a PowerPoint presentation, but I'm going to pull up here in a minute. But little other background: I'm a CFP, certified financial planner. I'm a certified life underwriter. When I got into the financial service, I've been in the financial services for almost 40 years. When I got into the financial services business, I got into the insurance part of the business. That's where I started, and specializing in these tax advantage strategies, setting up estate plans. And let me go from the beginning here. And these estate plans, when you're talking about setting up estate plans, it's not so much about growing your assets, but it's about keeping what you already accumulate. So that's really the difference between how you become rich and how you become wealthy. So the idea of becoming wealthy, it's not how much you make, it's about how much you keep. This is our home office in Clearwater, Florida. We own the building. We have 45 employees that work in this building full time on putting these strategies together and administrating them on a yearly basis for you. Again, the theme of the meeting is rich or wealthy. There's a lot of people that make a lot of money, the Henrys, or I see some professional athletes, they're making great salaries, great bonuses, great commissions. But at the end of the day, it's about how much you keep. And when we look at the different ways of what it's not so much about what you earn, again, about what you keep. And that's really the big difference. So when we look at these different tools that we're going to be talking about, the biggest thing to keep in mind is that when are you guaranteed that you're going to lose 40% of your estate? And it's the day you die without proper planning. So a lot of our theme is around estate planning and position your assets so you keep the money in your family, not to the IRS. So I want to bring up this a story, and this is a guy that thought he was doing all kinds of planning, Joe Robbie. I don't know how many people are familiar with this stadium, but in the 1980s, Joe Robbie's family owned the Miami Dolphins. And they named the stadium after him. It was called the Joe Robbie Stadium. Well, unfortunately, he died when he was like in his early 70s. Wasn't planning on dying. He was actually a real estate developer. A lot of his wealth was in real estate. Every time he had $1 million, he was looking for the new deal, just like a lot of real estate people are. And he had a basic estate plan set up. So he had a living trust. He thought he had everything secured. He thought if he lived a long life, he could transfer things to his family while he was alive using different gifting strategies. But unfortunately, he died too soon without the proper planning. And the stadium now became the Hard Rock Cafe. When he passed away, his family owed $100 million in taxes that were due 9 months after his death. They had the real estate was in a bad market, so they really couldn't sell the property at the time of his death, or they could have, but they could have sold at tremendous losses. So they decided to sell the team. They got $100 million. They paid the taxes. They still have all the real estate holdings. But real wealth is what this team is worth today, 20, 25 years later, 4.6 billion. So if they would have done the proper planning and would have structured their assets or structured their estate, they would have had the liquidity to take care of that $100 million liability, and their family still would have owned the team, and this is what it would have been worth today. This is true wealth. And with that kind of wealth, they could have done things with philanthropy, with helping out their community, with multi-generations. They could have had this wealth carry on. And when we talk about multi-generations, let's look at Vanderbilt versus Rockefellers. Vanderbilt was worth 185 billion in today's dollars. Rockefeller's worth 340 billion in today's dollars. Two richest guys at the turn of the century. Totally different plans. Rockefeller, I'm going to talk about his plan, but Vanderbilt passes away. 3-4 generations later, leaves Gloria Vanderbilt, his daughter, pretty large estate. She goes through like 5 or 6 marriages, 4 or 5 different failed businesses, leaves her son, Anderson Cooper, $1.2 million. Now, Anderson Cooper is pretty wealthy in his own right, but from a wealth transfer and generational planning, compared to what he had in today's dollars, 185 billion, to only have 1.2 million left, a lot of that was lost with no planning. Now, Rockefellers, on the other hand, had their planning set up. And when he passed away, same generation as Anderson Cooper, left Ariana Rockefeller $3.5 billion. Rockefeller has 150 great-great-great-grandchildren, just like Ariana, that he left $3 to $4 billion to. And the way they were able to do this is by setting up the proper trust planning and setting up multi-generational planning where they're avoiding the big hit, and that's the 40% estate tax. So I don't know how many people are familiar with this chart. It's actually a little dated, but because this thing changes every day. But the United States national debt is $31,718 million today. There's 334 million U.S. citizens in the United States that pay, that file tax returns, or that's the U.S. population. There's 127 million of that 334 million that file tax returns and pay no taxes. So more than half of the population that files tax returns don't contribute a dime toward the taxes. Now, if you look down here at the bottom, 187 trillion is unfunded liabilities. If the United States government did their accounting the same way that private companies do and publicly traded companies do, they would use GAAP methods of accounting, and they would report all their future liabilities and current liabilities on their balance sheet. They get an exempt from doing this because they're the government, but if they did, it would be $187 trillion of debt today and in the future to meet all their obligations and promises. That's over $559,000 per 334 million U.S. citizens just to meet all its future obligations. So when you see these numbers, the government has to do 2 things. They have to get fiscally responsible and start only promising what they could afford to spend, or raise taxes. And even then, how much could they raise taxes? Or do a combination of both. And it doesn't matter what side of the aisle you're on, because you can be both sides, Republicans and Democrats, keep raising the debt ceiling and finding more things to spend the money on. So in 2015, when President Trump came into office, he raised the estate debt tax exemption from 6 million to 12 million per person. But in order to get that passed through the Budget Reconciliation Act, they have to have this thing called a sunset provision. And what that means is in 10 years, in 2025, it started in 2015, in 2025, it sunsets back to the original law, which was 5 million exemption that was inflated to 6 million. So you can transfer, instead of 12 million each person with no tax, which would be a husband and wife, 24 million, down to 6 million husband and wife, 12 million total. with no tax. So what does that mean? For anybody that has an estate over $12.92 million after 2025, 40% of your estate will be eroded to taxes. And when we're talking with, IRA planning, like what CAMA does with your self-directed IRAs, you're deferring the income tax, which stays at 37, 40%, depending on what state you're in, could even be higher. But your qualified plans, you could lose 40% income tax, plus the state tax, plus the estate death tax. So we've done performers where we show people they're accumulating all this wealth in their qualified plans, and 60 to 70% of it can be eroded in taxes. So how do you avoid this? The first step is setting up a basic estate plan with your trust planning. With no trust, you have a will. And if you don't have a will, the states will give you one. And the big problem with having a will is your whole estate has to go through probate. Probate is the process of gathering all your assets, getting an inventory of all your assets. And when I say that, I always ask people, how many people that you know today know where everything you own and have details of all your brokerage accounts, all your LLCs, all your properties, all your bank accounts, all your insurance policies, and they have a complete inventory of everything you own? A lot of times I ask people that in group settings, and sometimes people say, not even my spouse knows everything that I have, let alone a third party to come in and get everything organized. But in the probate process, that's exactly what happens. Some executor is coming in and getting all the pieces of the puzzle, putting it all together. They have to file your obituary for 6 months to give creditors a chance to file a claim against your estate. And after 6 months, then they make sure that all the claims are worthy and credit worthy and that they're justified. And then they start selling the estate. Usually it takes a year to settle the estate. It could cost anywhere from 3 to 5% of your gross estate. So if someone's worth $1 million just to transfer their home and some other assets, it could cost somewhere from $30,000 to $50,000. If you're worth $10 million, it could be $300,000 to $500,000. And do the math. It could be more if the estate is larger. So when you set up a trust planning arrangement, they call it a living trust, a loving trust, a revocable trust. You retitle assets out of your name while you're alive, and you put it inside the trust. By putting it inside the trust, personally, you own nothing. Your trust owns everything. You appoint yourselves as trustees. So husband and wife, if you're married, manage all the assets as trustees. And you appoint yourselves as the beneficiaries of your trust. So you manage everything for yourselves. So by doing this, we avoid all those probate fees. And from an estate planning point of view, it's so important to do this because when you have a will, or if you don't have a will, the state gives you one, first spouse passes, everything goes to the surviving spouse. Between husband and wife, there's no tax. So when I talk about that $6 million exemption, it's not really an exemption. It's really a tax credit against a tax owed. So when you have things in joint tenancy and everything goes to the surviving spouse by contract, there is no tax owed. So if there's no tax owed, you lose one of the credits. And that credit is 40% on $6 million. That's a $2.4 million mistake. And I see it all the time. I even see it where people have set up trust, but they don't retitle all their assets in the name of the trust. They still have it in their names personally in joint tenancy. So when they pass, the lawyer got paid to set the trust up. Then he gets paid to probate the estate into the trust. And then the client loses one of their credits. So when you set up a trust, you set up what they call an AB trust. Everything gets retitled in the trust, so nothing's in your name. We avoid probate. First spouse dies, the estate splits up into 2 separate estates. You have an A trust, which is a marital trust. That continues to be revocable. Then you have a B trust. Think of the person beneath the ground. First person that dies becomes irrevocable. This is a family trust. The children are the irrevocable beneficiaries of the B trust, but they don't get it until the second person dies. So the second spouse has access to all the income and whatever they need for health, education, maintenance, and support. But because the kids are the irrevocable beneficiaries of the principal, it qualifies for the tax credit. So now we have two estates. A trust, $6 million credit, B trust, $6 million credit. So that's a $2.4 million problem that if you, or you know, if your estate's large enough, that could be a $2.4 million problem by not having it set up right. So the second, if you're fortunate enough to have an estate larger than $12 million, then we talk about setting up irrevocable trust. And basically what that strategy is everything you have over and above the 12 million, we start looking for ways to transfer assets out of your estate into what we call an irrevocable trust. Now, this trust has a separate tax ID number. This is what the Rockefeller set up. They set up Dynasty Irrevocable Trust to go to multiple generations. And what they did was, as they're funding this trust, when people come into it, when they pass, there's a large benefit that replenishes the trust, and it's a perpetual accumulation vehicle. And that's why Ariana Grande, that's my daughter's, that's why Ariana Rockefeller was able to accumulate, 3.5 billion with 150 other great-great-grandchildren. So here's the problem when you look at setting up irrevocable trust. You have to get assets out of your name and put it into this irrevocable trust. A lot of people get uncomfortable losing control because you cannot be your own trustee of an irrevocable trust, because the IRS says if you control it, then you own it, and they pull it back into your taxable estate. So somebody else has to be the trustee for the distributions of that trust. And that gets uncomfortable for a lot of people. So our solution is keep the assets in your name, let them accumulate, which is okay. But for the irrevocable trust, instead of you funding it, we're going to have a bank fund the irrevocable trust through loans. And we're getting loans today, even with the higher interest rates, like 6% locked in for 5 years. And then we can guarantee that the loan rate will never be more than 5% after the 10th year. And I'll explain to you in detail how that works. But what we're funding is a new type of insurance vehicle that has a benefit that will pay 10 times, 20 times more than what you put into it to your family, or replenish that trust, income and estate tax free. So the IRRs on this thing, when you look at the leverage, could be anywhere from 10 to 20%, depending how old you are and how much money we're putting into it. So I try to equate this to like a building. And for real estate investors, I say if I had a building that was worth $5 million, and I can show you a 7% cap rate on that $5 million property, and I have a bank that will fund the 100% of the $5 million purchase price, and you don't have to put down 20 or 30%. You put down zero down payment. And I can negotiate with the bank that it's a balloon note, so you don't pay back any principal for 15 years. And I negotiate minimum interest rates because these things are 100% secured by the assets inside the insurance policy. So the rates that we're negotiating in today's environment are 6%. And then I can guarantee it will never be higher than 5%. But if you can get money today, let's say after the 10th year, 5% guaranteed forever, and you got a cap rate of 7%, most people will tell you that you can make money on that property. And the returns with the leverage are double-digit returns. And because it's wrapped inside an insurance policy, it's 100% income tax-free. And because it's in an irrevocable trust, it's 100% estate tax-free. So how we're able to get these returns is very similar to what Warren Buffett does. Warren Buffett told his heirs in a Wall Street Journal article, he said, when I pass away, take the whole portfolio, put 90% in very low-cost S&P index funds, and take 10% and put it in short-term government bonds. And when the markets are doing well, draw from the 90% that's in the low-cost S&P fund. And when the markets aren't doing well, when they're down, don't deplete the market when it's down. Spend it from the 10% short-term government, secure bond funds. They said, and if you do this, you'll outperform like 85% of all money managers, because 85% of all money managers don't beat the benchmark, which is the S&P 500. And that, that's a fact. So he says you'll be 85% of all the money managers that are out there, and you own 500 of the best companies in America. That's a true representation of our economy. So we're doing the same thing that Warren Buffett is referring to do for his for his estate, and that's by setting up index funds. But we put the index funds and we wrap them inside an insurance policy. So by wrapping it inside an insurance wrapper, all the future growth grows on a tax deferred basis, and when it passes to your family as a death benefit, it's all 100% income tax free and estate tax free if we put in the irrevocable trust outside your estate. So I show this example that if you were investing in the market and you had the green dots was the market, you were lucky enough to get 15% versus our strategy, which is called an index life, and you put $100,000 into it, the market would be up first year 115,000. Ours has restrictions because we have guarantees that if the market goes down, you never lose a dime. So because of that protection on the downside, we cap you a little bit on the upside. In this example, 110, 250. Next year, market goes up again, 15, you got 132, we have 121. But if there's a correction in the market where it drops 30% from 132 down to 92, our program is guaranteed not to lose any money in down markets. You stay the same at 121. Now, of course, there are the fees for the insurance, but from the crediting standpoint, it stays the same. And then when the market goes up from the 92, another 15% the following year, you're back at 106 if you're directly invested. With us, because you have the protection, you're at 121, you go to 134. So that's almost a 30% increase because we have the protection on the downside. So when we look at a 20-year historical return from 2020 to 2021, the actual return of the S&P 500, not counting dividends, was 5.49%. Our strategy was 6.40%. So let me give you an example. I'm getting big banks that are funding these returns. And I can show you some of the returns in these things over the last, some of the indexes have done anywhere from 7 to 10% the last 20 years. The one I showed you was the S&P. We have other indexes that are a little more complicated, but they're called dynamic indexes that the returns are much, much higher, and I have historical returns to show you. So this is a person that was a real estate developer, and he was 61 years old, and he had an estate that was valued at $150 million, okay? So when we did a pro forma on his estate, we showed him that his family was going to lose, like 40% of that, which is like $60 million. So he had some planning done. He had, a trust set up. He actually even had an irrevocable trust, but he had nothing inside it. So what we showed him was, we said, hey, we can fund an irrevocable trust for $30 million that would be liquid the day you're gone. If you died tomorrow, if you died 10 years from now or 20 years from now, it actually will grow a little bit. We have a bank that will fund it for you for $2.2 million over 10 years. So we have a bank that will put in $22 million in the program. Now, as the bank puts money in the program and that loan increases, the cash value increases in the policy, and so does the death benefit. So when the person dies, the death benefit pays off that loan. We negotiated with the bank that the client was going to pay $100,000 for 15 years. So the client's going to pay $1.5 million out of pocket. Okay. That benefit grew at age 80, net of paying off the loan, to $32,600,000. If you did an internal rate of return, I'm putting out $100,000 for 15 years to get $32 million by the time he was 80, like a little less than 20 years, that came out to a 24%, 24.8% IRR on his money. So for $1.5 million, he bought $32 million of tax-free dollars to cover his future tax liability. Now, that wasn't going to cover his whole tax liability, but after he was in it for a year, he liked the concept, and he actually did one on his wife. And she was 60. We did 20 million on her, paid 40,000 for 20 years, 800,000. So 800,000 bought 26 million at age 80. That came out to a 28% return and change. So this client, for $2.3 million, bought $58 million in change of tax-free dollars outside his estate. So he can keep control of his $1.5 million, and he's got another 50 $60 million in an irrevocable trust that's going to offset all the tax owed on that $1.5 million. And he's doing that with tremendous discounted dollars of only 2.3 million. So I mean, that's like huge leverage. I have another example here. This is a person that the bank was going to put in $7.2 million over 10 years, 720,000. Client pays 50,000 a year for 15 years. So basically the client's using 7.2 million of the bank's money for $750,000. That bought a benefit of 10 million today. That grew to 22 million tax-free at age 85. So for $750,000, bought $22 million. So when you're doing your planning and you're forecasting your IRA accounts, and we're looking at your IRAs, and if you're fortunate enough to have a larger estate and your IRA is getting above the thresholds that allow it to transfer assets tax-free, you could be losing income tax and estate tax anywhere from 60 to 70% of your qualified plans. Here's a way where we take just a small percentage of your cash flow, use it for interest payments to create the dollars to offset those taxes. So that's really the plan. We have other estate planning tools. I'm not going to get into this one because there's more details, but the advanced planning strategies that we also do is we work with like 700 CPAs in the club. And what these CPAs will do for you is they'll review your last tax returns, and they'll forecast what your future tax liability is, not only estate taxes, but also income taxes. And they'll come up with recommendations and different tax strategies that you can use to free up dollars to fund these programs. This was a case of a company, they were pretty wealthy. We were able to review their last 3 years of tax returns, uncovered a $1 million tax recovery that they were able to get back from the IRS. And then they implemented a charitable planning strategy, conservation planning, some tax credits with solar and gas, and it saved them over $7 million of their taxes. They used some of that $7 million for the interest payments on the Premium Life Plus program I was just sharing with you, and they were able to leverage another 25 million outside their estate tax-free. And then here's another example using charitable trust planning. And this was a person that was selling a business, had an $18 million capital gain. By setting up what they call a charitable remainder trust, they transfer the property to the charitable remainder trust. They bypass the capital gains tax, which was over $15 million of capital gains. They saved $3.6 million in capital gains. The IRS gives them a deduction of $1.8 million for giving that to the charity down the road. Meanwhile, they get all the income off the charitable trust for the rest of their lives. Charity would end up getting, we take a percentage of that income, $80,000, and we finance an insurance benefit that started off at 20 million, that grew to 62 million outside their estate. And a charity got $38 million worth of tax-free dollars, ultimately when they died. So if they didn't do something like this, they would have had that estate of 18 million, 3.6 million would have went in capital gains tax. They would have had 14 million net of the sale. Now, assuming they lived a long life and they pulled out a really good income, they could have pulled out a huge income because these people were young in their 40s. They could have pulled out a huge income over their lifetime. And I show this exaggerated number, 163 million, but I show the comparison with the charitable planning, a lot more dollars to their families. So what we do high-end estate planning and income planning. We work with a lot of financial advisors all over the country, but if you're not a financial advisor and we could put you in touch with someone that we work with, or someone in our office. I help people all the time put together basic estate plannings, come up with plans for liquidity for their families or for business succession planning, and then we help them with their tax problems. Let's face it, people are setting up IRA accounts to avoid taxes, but if you look at what the government's spending on a yearly basis, someday those taxes got to be paid. And today we're at 37% income tax bracket. At the course the government's spending money on, most likely those tax brackets are going up. So we're kicking the can down the road to potentially just pay more taxes, in the future. So we put together, an estate tax organizer. We get everything organized. We have this cash flow analysis. We help you with your trust documents. We can help you set up buy-sell agreements or succession plans. These are some of the people on my top floor of my building. We have 45 people on our team that work with this stuff every single day. I don't have, this to give to you now, but if you're interested in any of this information, I thought I had my contact on here, which I guess I don't. If you can share that with them, Will, then maybe we can help some people out if they are looking for some more help. When you talk about the return, someone asked the question. Gerard said, "What are the fees to do a what if scenario?" It's less than $100 to review your tax returns. To do a brand new tax return with the CPA, basic tax return, we have a special promotion where they're doing it for less than I think it's like $195 or $210 for a basic tax return. First time offer. Did you set up?
Sorry not to interrupt, Vince. Thanks for all the information so far. I think the question Gerard was referring to was actually during the slides where you're going over the $150 million couple
Okay.
that you were talking about. Does that still apply?
When you're getting with advanced planning and you're setting up, irrevocable trust, it does. The fee that I just said was for basic, mom and pop, under that $6 million threshold. When you start setting up advanced planning and advanced trust, it can be more expensive. But setting up a basic trust, AB trust, durable power of attorney, living will, pour over will, healthcare surrogate, we have technology that's written by attorneys. The trust is actually executed by attorneys that specialize in this area, and they'll do a promotional offer for $595. I know that I priced that out in different cities and different communities, and the price is anywhere from, let's say 1,000 on the low end to 5,000 to an average maybe $2,000.
Great. And you said you didn't have your contact information slide now. If you want to, you can either type it into the chat or we can provide it at a later time after the webinar for people that inquire about it. But any questions for Vince while we still have him have his time, so to say? While people are warming up their typing fingers, obviously we work with self-directed IRAs, the CAMA plan, and IRAs in general. A lot of people I've spoken to equate IRAs in a lot of ways to trusts on the way that they're treated tax-wise from the government. Can you tell me what your key benefits are to either type of structure, should I say?
Well, when you're setting up, you actually don't put your IRA is kind of like a trust, because when you have a beneficiary on a qualified plan, it does avoid probate. It goes directly to the beneficiary. So you do not put your IRA inside your trust because it passes by contract by beneficiary designation. But when you're doing your total plan, it is still part of your total estate. And the IRS will tax you if you're above the $6 million mark and your IRA put you there. You could pay potentially income taxes and estate taxes on your qualified plans. So the key is maybe looking at converting some of that to Roth IRA today if we think taxes are lower, because it may make sense to convert it to a Roth if you think taxes are going to get higher. So we're actually paying the tax now, and maybe we can use some tax credits like solar deals or oil and gas deals to offset some of the tax. And you could do the conversion to a Roth, and then all the future growth will be income tax free. But the estate tax, if you're fortunate enough to have a larger estate, a lot of the probably half of the politicians think that you should pay your fair share, and the people that have wealth, it's a privilege, and they should be able to be happy that they're redistributing that wealth. And so it just depends, if you want to have the government get your money, or if you want your family to get it to do planning.
Great. Thanks for that answer. For people that are just learning about these types of trusts and their benefits, do you have any tools or resources that you would recommend that they can use to heighten their knowledge of the subject?
Well, we actually have someone contacts me. I didn't put my email address. I should probably put it in there too. The We have a video that I could get people that explains how trust planning works. But if you Google living trust or the benefits of living trust today, there's all kinds of information out there of setting up trust. Could you put my contact information, the vmuno@ufc.bz?
vmuno@ufc.vz.
No, BZ, boy zebra.
Gotcha.
So vmuno@unclefrankcharlie.bz.
Perfect. Excellent. Put an I in there for some reason. There we go.
Yep, that's it.
All right. Thank you
Yeah,
for
so I
that.
mean, I could put you in touch with the accountants. I can put you in touch with the attorneys. We quarterback a lot of this planning. Our specialty is funding those irrevocable trusts with bank financing. It's not for everybody, but for the people that are fortunate to have those larger estates, it makes a lot of sense. And it's a way to create liquidity when your estate's going to need it to offset some of those taxes.
Great. And when people are working with their financial advisors, or if they don't have one yet, what's a good way to gauge or do their due diligence on that financial advisor to know that they have somewhat of a knowledge with these subjects to better help them?
Well, I mean, I'm a certified financial planner. Usually, CFPs have to have continuing education. They're typically more committed to their occupation because they're doing continuing education on a yearly basis. And it just shows they have the discipline and they have the desire to want to learn all the time because you have to have so many hours of continuing education. And they have a standard that you have to follow, which is that fiduciary standard. And if you don't follow it and you get a complaint, I mean, you'll lose your designation. So I think that's a good place to start. We work with financial planners every day. So if you have a financial advisor and you like us to talk with them and work with them, look at this strategy and have them be involved, that's really what our business is. We work with other advisors is our primary customers, not so much the retail customer. So but we do work with retail people too. But if you have somebody that you're working with and you're comfortable with them, we'd be happy to, talk to them and see if this makes sense for your situations.
Great. Thank you for that. It looks like your presentation was so well-rounded that it didn't leave much for questions, or people are just still thinking of them and need to digest it. Whether it be people live now or watching it in the future, please use the contact information that was discussed to reach out to Vincent with any questions, or have your advisor reach out to him. And then if you have any questions about self-directed IRAs, on the other hand, please feel free to contact Camaplan at any time. We're always happy to help. Vincent, thank you so much for lending your time and providing all of this information. Do you have anything that you want to leave people off with before we end the presentation?
William, I'll just finish with what we started with. It's not so much how much you make, but it's how much you keep. And to keep everything, you have to do your homework and you have to have a plan and map things out and know where you are today and where you're potentially going. And that's what we could help you with. And setting up a self-directed IRA, that's one. That's like the first step in your qualified plans. But if you're an individual investor, is probably making better returns than what you think like a mutual fund can be making for you. But again, it's preserving it and protecting it and keeping it. So that's what we can help you with.
Great words of wisdom. Thank you again, Vincent. Thank you, everybody viewing now and in the future. I hope everybody has a great rest of their day.
Thank you, William. You too. Have a good
Thanks.
day. Thanks,
Thanks.
everybody.